Next question. On 1st of January, commodity X has a value of rupees 100. Mr. ABC has rupees 20,000 available for investment. Highlight the portion nominal rate of interest or inflation adjusted rate of interest is 33.10 percentage. Inflation rate is 10 percentage. You are required to calculate a few questions are there. First question, with the amount held by Mr. ABC on 1st of January, highlight the portion how many units can be purchased of X commodity today. What would be the price of the commodity X at the end of the year on 31st of December? If Mr. ABC invests rupees 20,000 at the prevailing rate of interest, that is over here like 33.10 percentage for 1 year, then what will be the maturity amount of the deposit on 31st of December? With the maturity amount of the deposit, what number of units can be purchased of X commodity on 31st of December by Mr. ABC? Based on above information, you are required to calculate real rate of interest. That is a question. I request all of you to give answer of the first 4 questions in the chat box. First 4 questions. The first question is, with the amount held on 1st of January, how many units can be purchased of X commodity? I request all of you to write down answer along with me. Answer of the first question would be like this. Amount divided by price per unit. It would be calculated like this. Amount is rupees 20,000. The question is providing that the price of the commodity today is 100. So you can buy 200 units right now. That is on 1st of January, with the amount held by you, you can buy 200 units. The second question is that what is the price of the commodity after 1 year? We understand that it is current price into 1 plus inflation rate. Current price is provided to us as 100 rupees. Inflation rate is 10 percentage. That comes to 110. That is what the price at the end of year 1. Third, the question says that if Mr. ABC is investing 20,000 as the prevailing rate of interest, that is 33.10 percentage for 1 year, what will be the maturity amount of the deposit? So we understand that as far as the maturity amount is concerned, it can be calculated as investment into 1 plus rate of interest. Investment is 20,000. Rate of interest is 33.1 percentage. So we understand 20,000 into 1.331. That comes to 26,620. That is with the maturity amount that we have. Next question is, with the amount of the maturity, how many units can be purchased of the X commodity? So answer of the fourth question is amount divided by price. We understand at the end of the year, maturity amount of the deposit is 26620 and the price is 110. So it comes to 242 units. So this is the number of units that can be purchased at the end of the year. So basically we understand that over here the term nominal rate of interest means the rate of interest which is prevailing in the market for investment. That is considered to be the nominal rate of interest. Means if at all we make investment in any of the deposit and whatever the rate of interest that we are getting is called nominal rate of interest. Or let us say that's in a normal term, uh, we make the calculation of the return on Sensex or return on Nifty, return on Infosys investment, HDFC investment. All those are considered to be the nominal rate of interest. The term nominal stands for, so it is always the inflation adjusted. That is what we understand is the term nominal rate of interest. Now basically the fifth part of the question is most important, for which we are doing this question in the classroom. The question says that say based on above information, you are required to calculate the real rate of interest. That is the question. Now what do we understand with the term real rate of interest? The term real rate of interest stands for the increase in the purchasing power of the funds is considered to be the real rate of interest. I request all of you to pay attention. We are required to make the computation of real rate of interest. What do we understand with the term real rate of interest? It means increase in the purchasing power of the funds is considered to be the real rate of interest. It can be calculated by one of the two methods. One method by which you can calculate is over here like this. Listen carefully. We understand it's the change in purchasing power divided by number of units. At the beginning of year. So what do we understand? We understand something like this. That say the funds that you had at the beginning of the year, with that say you were able to purchase 200 number of units. You made investment of the funds and with that say you would be able to purchase 242 units. So you are able to purchase more number of units. How many more units, friends? 242 minus 200. So you can purchase 42 units more. So purchasing 42 units more in comparison to 200 that you were able to buy at the beginning of the year. So into 100 for getting answer in percentage term, and the answer is 21%. What do we understand with the term 21%? It means that so the increase in the purchasing power of the funds. Why? Because we understand that so the rate of interest at which you are getting the return is more than the inflation rate. So you are able to get the return at 33.1%, and against that so the price of the commodity increases only by 10%. That is the reason so you are able to get the increase in the purchasing power of the funds. This answer can also be calculated like this. Listen carefully. 1 plus nominal rate of return is equal to 1 plus real rate of return into 1 plus inflation rate. I request all of you to pay attention. Do not write anything. If at all I am making investment of 1 rupee today, it becomes 1.331 at the end of the year. By that time, so the commodity which is having price of 1 rupee becomes 1 rupee 10 paise at the end of the year. So what is the rate at which say the purchasing power of the funds increases is required to be calculated as balancing figure. I repeat my explanation. Investment of 1 rupee today becomes 1.331 at the end of the year. By that time, so the product which is having value of 1 rupee becomes 1 rupee 10 paise at the end of the year. So what is the rate at which the purchasing power of the funds increases is required to be found. I'm sorry, what is the rate at which the purchasing power of the funds increases is required to be found as balancing figure. So we understand that, so the 1 plus R is equal to 1.331 divided by 1.10. So R is equal to 1.331 divided by 1.10. Whatever the answer, that say we get minus 1. So over here 1.331 upon 1.1, whatever the answer that we have, minus 1, it is 0.21 into 100 for getting answer in percentage term, that comes to 21%. This is the way we are required to make the calculation of, say, the real rate of interest. Friends, I just try to remember the formula as NRI formula, non-resident Indian. That is the way I try to remember the formula, NRI formula. So just write on a small note. Real rate of interest is indicating the rate at which purchasing power of funds increase. Full stop. Over here we can see that nominal rate of interest is more than inflation rate. Full stop. So real rate of interest is positive. Full stop. Over a long period of time, always nominal rate of interest exceeds inflation rate. Full stop. This is the way we understand that's the kind of relationship between the nominal and the real rate of interest. And always remember, dear students, that whatever the rate of return that say you have studied anywhere so far is always the nominal rate of interest. Further we understand that, listen logically, that say whatever the cost of capital calculation that we make is also the nominal cost of capital. We understand that, say, let us say when we compute the term weighted average cost of capital, then in that case it is cost of equity into weight of equity plus cost of debenture into weight of debenture plus cost of preferential into weight of preferential. We have to understand logically like this, that cost of equity is calculated by number of formulas. One of the formula which I am writing over here, it is CAPM RF plus beta into RM minus RF. we understand that say the risk-free rate of return has to be more than the inflation rate. Why? Because if at all that say the price, that is say the commodity prices are increasing at a higher rate in comparison to say the rate of interest at which you are getting the return, then in that case say nobody would invest in currency, everybody would make investment say in commodity only. Nobody would invest in any security if at all say the return from the security is exceeding the inflation rate. So we understand that say the risk-free rate of return has to be more than inflation rate, and that is considered to be the nominal rate of return. So this is also supposed to be the nominal rate of return. As far as the cost of debenture is concerned, in calculation of the cost of debenture, we know that say we use the formula like this. There are number of formulas that we have, but I am say explaining to you one of the very simple formula. It is rate of interest into 1 minus tax rate. That is the way the cost of debt financing is calculated. Listen carefully. Now cost of debt financing is calculated like this. In that say this rate of interest is also, it must exceed the inflation rate. If at all I am investing in the debenture of the Reliance and so the rate of interest which I am getting is less than the rate at which the price of the commodity are increasing, then I would not prefer to invest in the Reliance security. Further, logically you can always understand that this rate of interest has to exceed the risk-free rate of return, because Reliance security cannot give you a return which is less than what central government is offering. As far as the cost of preference share is concerned, in that also we take the preference dividend rate into account. That preference dividend rate is like, again we understand that say must take into account the inflation. So whatever the working that say we have done so far at any point of time in our financial management is always in the nominal term. So this is the way we make the calculation of answer. And just to remember, it is called like the NRI formula. It is non-resident Indian formula like that. So you can just remember it.